Hello, my fellow investors, and welcome back to another earnings report video. Today, guys, let's cover a company that had earnings this week that I unfortunately could not cover because, well, it was the same day of Nvidia. And guys, I'm talking about the company Foot Locker. Now, somebody actually did ask me, hey, could you take a look at Foot Locker because it has fallen a lot. And normally right now I'm not taking recommendations. However, I figured they just had earnings. And the fact that they fell a lot, I kind of do want to take a look at this. So we are going to cover Foot Locker today, and let's read their earnings. Of course, the link is in the description below for everybody who wants to read it for yourselves, which is highly encouraged. And also, we're going to take a look at their fundamentals and see what kind of price we should pay for this company after the whopping drop that they had recently. So with that said, let's get started with this analysis. So here we have their earnings summary. They announced this on the 23rd. We got EPS normalized actual at 4 cents. That was a miss by a penny. The gap came in at -5 cents. That was a miss by 10 cents. Revenue of 1.86 billion. That was a miss by $21.4 million. So all in all, miss, red. It was awful. Now let's jump into their actual earnings report. And as I said, guys, this will be linked in the description below. Because, again, I don't want these videos to be too long. I'm only going to go over their main highlights, the CEO comments, and any guidance that they had in the earnings report. So, again, this will be linked in the description below for you guys to read for yourselves, which is highly encouraged if you so wish to buy into this company. All right, so we got over here. We got total sales decreased 9.9%, comparable store sales decreased by 9.4%. When it comes into any kind of retail company, you really want to take a look at comparable store sales. And yeah, the fact that this decreased by 9.4, it is a major thing, right? We got EPS loss of 5 cents and non-GAAP of EPS of only 4 cents gain, lowering 2023 sales guidance and earnings guidance. That is really bad. Pausing a dividend. So they did so bad that they are pausing the dividend to enhance flexibility. We can actually see this when we go into the calculator because, well, their free cash flow went into the negative. And as I say, guys, free cash flow pays for a dividend, and there it is. That's the reason why you want to take a look specifically at free cash flow if you want to make sure that that dividend is safe. And lastly, we got over here reiterating commitment to lace up plan. I don't really know what that means. Maybe you guys know. All right, let's jump into now the CEO's comment. We got Mary Dillon, President and CEO, said our second quarter was broadly in line with our expectations. Wow, expectations being that low. Despite the still tough consumer backdrop, however, we did see a softening in trends in July and are adjusting our 2023 outlook to allow us to best compete with price-sensitive consumers, while still leaning into the strategic investments that drive our lace-up plan. I don't really know what that is again. Importantly, we are continuing to make progress in our inventory levels and look to best position in the business for the upcoming holiday season and into 2024. Ms. Dillon continued, we remain committed to our lace-up plan as introduced back in March of 2023 Investors Day, and we are encouraged by the progress we are making against our strategic priorities heading towards the holiday season. To ensure that we have flexibility to continue to fund our strategic investments appropriately, we are pausing our quarterly cash dividends beyond our board's recently approved October payout. Okay, so they are paying it up until October, but after that, they're stopping it. I see. We intend to update the market on our go-forward capital allocation plans and the timing around our long-term financial targets when we report fourth quarter results, meaning that they're going to stop it for now, but they'll update it in the fourth quarter results, so like in December. Okay, so that all makes sense, and I gotta say, guys, that's not surprising in the slightest, the fact that they suspended the dividend. Personally, for me, I would prefer if they suspend the dividend rather than taking on debt and the company going under, right? I personally would like that. In fact, there has been some companies, even companies that I own, that I'm just like, I think that they should cut the dividend because it's just not really sustainable. All right, let's move on into the second quarter highlights. And most of this we already saw. We got total sales decreased by 9.9 to $1.86 billion as compared with sales of $2.1 billion in the second quarter of 2022. That's a big drop. Excluding the effect of foreign exchange rate fluctuations, total sales for the second quarter decreased by 10.2. Comparable store sales decreased by 9.4, driven by ongoing consumer softness, changing vendor mix, and repositioning of Champ Sports. I don't really know this. Please refer to the sales banner. Okay. Gross margin declined by 460 basis points. We got SG&A increased by 190 basis points as a percentage of sales compared to the prior year, with savings from the cost optimizing program more than offset by underlying deleverage on the sales declining inflation investments. Okay, the company had a loss of $5 million in the second quarter. Wow. The company had a loss of $5 million as compared with a net income of $94 million. Yeah, that's pretty much what we just saw over here, right? They had a loss of what, 5 cents? So there it is. There's the $5 million as compared to the $94 million in net income in corresponding the prior year period. On a non-GAAP basis, net income was $4 million as compared to the $105 million in corresponding year. That's insane. For the quarter, the company had a net loss of 5 cents per share as compared to the net income of 99 cents per share. Wow. In the second quarter, wow, dude, they just went from a positive $1 essentially to a negative 5 cents on a oh my lord, on a GAAP basis, and then on a non-GAAP basis decreased to 4 cents from $1.10. That's absolutely insane. All right, let's also take a look at now the dividends and share repurchases, because this is huge too. During the second quarter 2023, the company paid a quarterly dividend of 40 cents per share for a total of $37 million. The company did not repurchase any shares during the second quarter. In fact, they actually issued, we're going to take a look at that in 1 second too, to increase balance sheet flexibility and support to longer term strategic priorities. The company is pausing its quarterly dividend cash beyond its recently approved payout. There it is. So yeah, that's not really surprising. When we take a look at that free cash flow, you're going to see exactly why. And as I said, guys, this is something that I actually would prefer, because I would like a company to survive. If that means that they don't pay out the dividend, then so be it, right? And lastly, when it comes to the outlook, we have a bunch of stuff here, but let's take a look at the sales change, I guess you could say. So here we got the outlook. We got sales change. Prior guidance down 6.5 to 8%. Now it's down 8 to 9%. Wow. All right. We got comparable sales. It was down 7.5 to 9.0. Now it's down 9.0. They're shifting everything by like 1 or 2. That's absolutely crazy. Square footage change. Okay, so that's no change there. Licensing revenue. I don't really care about that. Right here. Non-GAAP, oh no, that's the target. Oh, right here, non-GAAP EPS, $2 to $2.25. That was a prior guidance. So now $1.30 to $1.50. Wow. And capital expenditures actually went down, $305 million to $290 million. So that is just absolutely insane. All right, guys, let's come now into the calculator. Let's see their fundamentals on the 5-year scale. We got the ticker for FL, market cap of $1.62 billion, a P of 11.18 with a current share price of $17.21. Now, this thing had a massive drop very recently. I mean, you guys can see that right there. This was in May, right? This was just Q1, and you had a massive drop going from what, 41 down to 25, remaining around 25, and then after this drop, after this earnings report, from 25 down to what it is now of $17. So in the 1 year, this thing is down a whopping 54%. Year to date, it's roughly the same, 53.5. And yeah, I mean, we are pretty much near 52-week lows, $14.84 to $47.822. Is this a good buy right now? I guess we'll find out, man. I guess we'll find out. So let's come back over here. They do pay out a dividend. At least they're going to pay out a dividend up until this last payment, which is going to happen in October, but then they're going to stop. So I'm going to put it at 0. Even though if we come over here to Seeking Alpha, we can see that, well, this was a whopping yield of 9.16, guys, at 40 cents per share. That's a pretty big yield. And you can see that the payout ratio wasn't even that big. However, the payout ratio in regards to the free cash flow was massive. 5-year CAGR was 4.08. With 1 consecutive year, this is going to get cut too. Now, this is the last dividend payment that you're getting. October 12th is the ex-dividend date, payout date. So you still actually have a chance. And then October 27th, the last dividend payout date, until further notice, will be on October 27th. And lastly, dividend frequency is, of course, quarterly. So let's come back over here, and I'm going to put 0 for now because, well, guys, if we take a look at these free cash flows, you can see that the 5-year average is 470, looking really good, but last year's free cash flow was negative 112. So that right there explains as to why they're cutting the dividend, because, or they're not even cutting it, suspending it, because they can't afford it when it comes to this kind of free cash flow. In fact, if we put over here the annual dividend yield that they had before, so it was $1.60, we can see that this last year's free cash flows payout ratio is negative 134. So even though the average is only 32, guys, the fact of the matter is that this is actually a good thing that they are suspending it. So let's jump into now the fundamentals. We got the net income 5 years ago of 541 million to 1 year ago of 342 million. That is a decrease of 37%. 5 to 3 years ago decrease, a massive spike 2 years ago, and then it came back down. Another perfect example as to why you can't just take 1 year as an outlier and call it a trend, right? So fact of the matter is, I'm giving this a 40%. This is pretty continuously going down, right? Except for like 3 to 2 years ago, 3 to 1 year ago, it's essentially going down though. All right, looking now at the free cash flow, this one is looking horrendous. This one is continuously decreasing, all except for the 3 year ago value. 5 years ago of 594 million to 1 year ago of negative 112 million. Guys, that is a decrease of 119% with an average of $470 million. This is continuously decreasing. If you take out the outlier 3 years ago, I'm going to give this guys a 0%, especially the fact that they just went into the negatives. Looking now into the revenue actually isn't looking too bad, but we just saw their comparable store sales go down. 5 years ago of almost $8 billion to 1 year ago of $8.76 billion, increase of 10.33%. This is looking good. However, I do expect this to come down. I'm going to give this so far though an 80%. When it comes into the assets minus liabilities, very similar to that of the revenue, you can see pretty consistently increasing except for like 5 to 4 and then from 1 to today. But all in all though, it's looking all right. Average total assets is 7.44 billion. Average liabilities is 4.44 billion. Doing this difference, we get a little bit more than $3 billion. I'm going to give this guys an 80%. Looking now into the cash flow minus liabilities, continuously decreasing all except for 1 year, and that was during COVID. Not really surprising since they had a massive influx when it came to their cash flow. All in all though, significantly decreasing year over year. 1 year ago, it was negative 4.73 billion, the average being negative 3.37 billion. I'm gonna give this guys a 0%. Now the shares outstanding is interesting because they went 5 years ago of 112.2 million shares to today of 94.2 million shares. That is a decrease of 16%. However, a slight uptick in their shares outstanding from 1 year ago to today of a little bit less than 1%. Now, I personally think that the reason why they're cutting this dividend is because they don't want to issue shares, which is actually a great thing. However, we are seeing a little bit of an uptick here. So this is a little bit worrying, but I think that they cut that dividend because they don't want to issue shares, which is actually a good thing. You don't want the company to be diluting. However, I do foresee them to issue a little bit of shares into the future in order to subsidize the cutting the dividend as well. So just keep that in mind. That's why I'm giving this a 60%. And lastly, cash and equivalents, they currently hold $180 million with an average of $833 million. When looking at the overall grade, net income 40, free cash flow 0, revenue 80, assets minus liabilities 80, cash flow minus liabilities 0, shares outstanding of 60, overall grade of 41%. It's definitely a company that's struggling, especially when it comes to the free cash flow as well as even the net income. So now let's take a look at what this company should be worth after that massive, well, 2 drops, honestly, because they fell pretty much every single earnings. Now, not inputting anything, we got $5.99 not adjusting for debt, and that adjusting for debt, it goes into the negatives. They have a ton of debt in relationship to the cash and equivalents, which is why this goes into the negatives. So we're only going to be focused on this non-adjusted for debt kind of figure. Now, the thing is that when it comes to the projected share buyback, I think that they're going to issue shares, but I think they're going to issue shares at a really, really low rate. I would actually argue less than 5% in the next upcoming year. So let's say -5, let's say -4, and then let's say -3. The negative just means that they're issuing. Now, when it comes to the revenue growth, seeking off of saying a -3.2, sorry, a -3.12. So I'm going to say -4. I'm going to say -3, and then I'm going to say -2. With this, guys, we get $4.92 to $5.41, not adjusting for debt. And of course, adjusting for debt, this thing just goes into negative. So even after that massive drop, we still see that this is still very, very expensive based off of my assumptions. But as I always say in every single video, this is my assumptions, guys. Please have these calculators. They're available for free. Anybody could use them. I got this one, the book value one, the REIT one, and even the dividend tracking sheet. The earnings report is in the description below. Please read it for yourselves because this is not financial advice. Every investment is the present value of all future cash flow, and I highly encourage everybody to do their own due diligence because this is not due diligence, okay? I'm just showing you guys my basic opinion. This is not a company that I own. This is not a company that I want to own. If you want to own it, you need to make that decision for yourselves, and you need to make sure that you know what you're getting into because you can and possibly will lose money when it comes to investing. So just keep that in mind. I give all the tools out for free. All we're asking for in return, guys, is just please subscribe to the channel, like, comment, and of course, share with your friends if you do like this type of content, okay? That really is all we're asking for. You know, we just really want to grow. We really would like to be the #1, I guess, financial education investing channel here on YouTube as well as Rumble. So again, guys, thank you so much, and thank you so much for stopping by on the live streams. You guys are all great. Again, all we ask for, if you do wish to help us, it is like, subscribe, comment, and of course share. And now lastly, when it comes to the options change, looking at the September 1st, hard to believe we're already in September, at the September 1st expiration date, guys, man, this company, even though with that massive volatility, there is no premium at all when it comes to the puts. And when it comes to the calls, there literally is nothing either. So not really much to say here when it comes to the premiums, but you know, here is the options change for September 1st, 2023 expiration date. All in all, thank you so much for telling me to do Foot Locker. Again, guys, it's a company with a lot of volatility, and if you believe that they're able to recover, then this is looking like well, it looks like they still need to fall a little bit more. However, it really is difficult, right? Because at the same time, it's like I think they lost like the whole thing partnership with like Nike or something like that. So you really do have to make that decision for yourselves. I don't really want another company that has to do with shoes, so it is what it is. All in all, guys, that pretty much does it. Again, y'all can follow us on the YouTube sites, link is in the description below. So with that said, peace out, and we'll see you all next time.